So to start off, I'm going to show myself and say hello as requested in instructions. So hello, my name is Carla and I will be presenting my stock project. Okay, so let's start off here. So I'll be talking about the weekend effect. So starting out by defining the weekend effect, the weekend effect is an anomaly that sees stock prices fall on Mondays following a rise on the previous trading day, which is usually Friday. The timing translates to a recurrent low or negative average return from Friday to Monday in the stock market. And this information was taken by Investopedia in 2018. So my personal analysis is that this negative return can be referred to as a market inefficiency, considering that Monday's returns should be either similar to Friday's returns or at least higher than Friday's returns. Since you have Friday, Saturday, Sunday, Monday's returns should not be lower than Friday's returns. So some prior research that I did was, prior to choosing my topic, I researched interesting theories in the stock market and found that the weekend effect was pretty interesting, and so that's what I chose, and I found an article about it and used that as a source of inspiration for my project. So how did I avoid bias and determine statistical significance? So first of all, there was a couple of modifications I had to do to my projects. It was necessary after I realized that some of the stocks that were chosen, which via the random stock picker generator, which is what it's called, did not have data going 5 years back. So then the stocks that did not have data going 5 years back, I had to replace. So I went back and changed those stocks to new stocks that were again chosen by the random generator. And these stocks had data dating back to like 10 years. So we were good to go there. And in order to find this data, I pulled everything from the NASDAQ website, and it was pretty easy to find, but hard to pull the pairings of Mondays and Fridays that I chose. The assumptions that I made was I had the preconception that the weekend effect would prove to be significant. So, avoiding bias and determining statistical significance. So I'm kind of walk through my calculations now. I'm gonna pull up my Excel file. Right, so here is the Excel file that I created. So we have the stocks that I chose, which are here highlighted in yellow. The dates. So I started off with, I would get Mondays, Fridays, and then Thursdays. And the reason I would get Thursdays is because you need Thursday's date to get the return on Friday. And then you would use Friday's prices to get the return on Mondays. So I did that, and I collected pairs of dates every year from 2018 to 2013 for each stock. So you see there's 3 for 2018 here, and then we have 3 for 2017, 3 for 2016, 3 for 2015, 14, and 13, and so on. And so I gathered the close, volume, open, high, low data, and then I calculated the returns, which as you can see is the price today over the previous day price minus 1. And so then after I did that for all of the stocks here, which happens to be 192 rows of data, I calculated the returns for all of those, and I used that formula going all the way down. I looked at which return was larger, Monday or Friday, and so then I put F if it was Friday and M if it was Monday, and then I used an if-then formula to give me a number of 1 if on this column if it's on Friday. So I dragged that all the way down, and then I summed that over here. So I summed all the ones here which were given if on column J Friday was higher, and so that equaled 30, and I did the same thing on column L, same formula, but this time it was if M was given or shown, or M was higher, which is Monday, and so I summed that up over here, and I got 30 for both, which is crazy, and I did not expect that. So I have 30 Fridays are higher, and then 30 Mondays are higher, which is really interesting that it's completely even, and I thought that was kind of weird. And so then I went individually into each data set for each stock, and I calculated the percentage of times it's Friday and then Monday is higher. And so I have six date sets or pairs, I would call them, of Mondays and Fridays in each stock. And so this one has 5 Mondays or higher, so 5 sets of Mondays. So in 2017, 2016, 2015, 2014, and 2013, Monday was more significant in the dates that I pulled, and then only 2018 Friday was higher. And so then I did the math for that and found the percentage. So this number out of 6, because there's 6 pairs or 6 years analyzed, or not 6 years, but 6 pairs of data, so 2013 to 2018. Yeah, 6. And so I did that, and I got the percentages, and then so I did that for all of them. And Friday was actually only higher here for this stock, FOE, and then 2 more times down here, 83%, 83%. And other than that, it was 50% a lot of times. So here it's 50%. Here it's 50%. And, well, that's twice. But I found that to be really interesting. I didn't expect that. Oh, it's 3 times. Yeah, 3 times. So I found that to be really interesting. And so that's how I got my data and the kind of math that I did on my data. So going back to the presentation. So yeah, those are the calculations that I did, and I predict that the investors cannot beat the stock market using my strategy of taking into account the weekend effect, because although I thought the weekend effect was significant, after looking at my data, it honestly does not look like it is significant. It doesn't, it was a 50-50 chance of Monday being greater, and 50% of the time Friday was greater. So I don't really think that you can make an investment based off of the weekend effect. I don't think it proves to be true or as significant as I thought it would have been. And so now explaining the efficient markets theory. So according to the efficient market theory, stocks are always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing, and the only way an investor can possibly obtain higher returns by purchasing riskier investments. And again, this was taken by Investopedia. So the question here now is, are markets efficient? And can you beat the market using your strategy or this strategy? And I said, yes, markets are efficient, but it's impossible to beat the market. I mean, it is possible to beat the market. However, it's extremely difficult. And what I kind of mean by that is I don't think markets are efficient 100%. I think there is some inefficiency. And of course, as mentioned in this quote, that comes with riskier investments. So I think it kind of depends. And so how did I avoid bias in my sampling and setting up of the experiment? I used a random stock picker generator to avoid bias, which I said at the beginning of the video, and I emulated experiments that I found via research. Did you do any kind of statistical test to determine if the results were significant? Yes, they weren't significant enough. It was a 50-50% output. And so overall, it definitely was not what I thought it would be, but in the paper that I read, it kind of had the same results, where in the 1970s the weekend effect proved to be true. However, recently it has not proven to be true, and it's kind of just by chance. And people have been looking more into this. So maybe there are more efficient ways to do the experiment, or maybe there's a different approach to it, but I don't think that it proves to be significant. And yeah, those are my results. Thank you for watching. And yeah, I'm gonna close out the video now.